Today on InvestTalk, we covered what happened in the market today, talked about the 5 trends that could be facing the energy sector in 2025, answered questions on UHT, employee stock options, and a broad question on portfolio management, and then ended the day talking about how the market is digesting changes coming during the Trump administration.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point today concerns an important topic, and that is what 5 trends will be shaping oil, gas, and energy in 2025. If you can hear my cat, she's very interested in what is going to be shaping energy in 2025. So let's dig in for you and for her. Now, the energy industry is bracing for significant changes this year, from a renewed focus on domestic oil and gas production in the US to an ongoing push for decarbonization that has been a trend over the past several years. And all of these trends are shaping how companies, but also policymakers, balance today's energy demands with those future priorities. So let's explore 5 key developments to watch in the coming year. First, a second Trump administration is expected to prioritize domestic energy production. This could solidify the U.S. as a leading oil and gas exporter and put some downward pressure on global energy prices. But at the same time, decarbonization efforts may slow, with a potential rollback of EV incentives in favor of these long-term renewable solutions like hydrogen. But it's important to note, right, there are more countries out there. Even if we decide to slow down in the U.S., Europe is still likely to double down on renewables and EV adoption in a response. Second, decarbonization still remains in focus. Despite a U.S. pivot towards hydrocarbons, global forces like international carbon credit trading and stricter regulations will still push energy companies to integrate emissions tracking and carbon reduction goals into their overall operations. So what you should expect is continued investment in renewable energy and carbon capture, and overall, importantly, EV charging infrastructure. Third, efficiency in hydrocarbons is really becoming a priority. To optimize operations, companies are moving away from costly, customized digital systems and really starting to embrace industry standard IT solutions. This shift really aims to do a couple things. It aims to cut costs and, more importantly, refocus resources on those competitive advantages rather than routine workflows. Fourth, AI is set to transform energy operations. As we all know, generative AI will probably help companies improve decision-making, particularly on the financial side, right? Commodity trading, risk management from banks, from financial services companies. And by embedding AI into their digital environments, energy firms will be better equipped to adapt to shifting markets in real time, to explore new opportunities in real time more quickly, but also with less cost. And finally, number 5, partnerships and collaborations are taking center stage. And I'm not just talking about collaborations between AI companies and energy companies, right? We're thinking of Microsoft and getting 3 Mile Island restarted, getting nuclear power. But energy companies are joining forces with each other to innovate in areas like biofuels and energy storage and hydrocarbon production. And by working together, not only are they sharing the benefit, not only is it cheaper, they can also share the risks, and they can accelerate progress and use those competitive advantages to drive progress and growth, delivering new energy solutions to customers and new profits to shareholders. As always, the future is uncertain, but it seems pretty likely that as 2025 unfolds, the energy sector will navigate these trends while balancing short-term demands with long-term sustainability goals. Don't miss out on critical market updates. Subscribe to the KPP Premium newsletter for weekly insights delivered straight to your inbox. Let's talk a little bit about the U.S. market today. U.S. stocks were narrowly mixed in fairly choppy trading, though finishing a little bit off of their worst levels. Relative underperformers included semis, energy, chemicals, steel, and utility names. Outperformers included managed care, airlines, home builders, exchanges, waste, and beverages. The Dow finished up 25 basis points, S&P 500 up 16 basis points, NASDAQ down 6 basis points, and the Russell 2000 small caps down 48 basis points. Treasuries mostly firmer with the curve steepening after a well-received 30-year auction. The dollar index up 40 basis points, gold settling up 30 basis points, and crude oil settling down 1.3%. Another day with a number of moving pieces, I would say. Tariff concerns back in the headlines, with CNN reporting that President-elect Trump is considering declaring a national economic emergency to implement tariffs as quickly as possible once he takes office. Now, while such a legal path is not really surprising, kind of still fits with the broader uncertainty surrounding the second Trump administration that has been cited as a major factor behind the pickup in overall volatility in the market. Comments from Fed's Waller lean more dovish, though March easing odds still below 50%, and the market's continuing to expect less than 50 basis points of easing through the full year 2025. We'll talk a little bit more about the Fed minutes later on. Economic data mixed ahead of non-farm payrolls on Friday. Elsewhere, the ADP private payrolls up just 122,000 in December versus 135,000 consensus. Hiring slowing across several industries, with manufacturing shrinking for the third straight month. Weekly initial jobless claims printed at 201,000, well below the 215,000, though continuing claims were higher week over week, so not all bad news there. On the used vehicle front, the used vehicle index for December down 30 basis points month over month, though up 40 year over year. Most it's been up since August of 2022. Stock market is closed as a reminder tomorrow in observance of President Jimmy Carter's state funeral, but the bond market will be open. December jobs report and University of Michigan survey cap off the week on Friday.
Hi, this is Daniel from Crosby, Texas, calling about the stock ticker HRB, H&R Block. Was interested in your thoughts on this one, and what do you think is a good entry point? Thank you.
So that would be ticker HRB, H&R Block. H&R Block is a tax return preparation service, main competitor being TurboTax, owned by Intuit. And, over the past couple of years, really, I think over the past 5 years, they've been saying they're going to implement this, but there's been a pilot program from the federal government that, as you know, through the federal bureaucracy, takes time to get through, that essentially is trying to offer a free option for tax filing services like many other countries have. And years ago, when I heard about this, I thought that maybe companies like H&R Block, companies like Intuit, would suffer from that. Now, over the past year, H&R Block is up 15% year to date. It's only up 2%. It's down 12% over the past 3 months. It had some disappointing earnings a couple months ago. This most recent quarter was okay, but the quarter before that was not too great. It's got about $1.9 billion in debt on a $7.3 billion market cap company, 2.8% dividend yield, which has been relatively consistent over the past 5 years. Now, revenue has kind of stalled, right? They had $2.6 billion of revenue in 2019, and that was growing over the past 5 years about 6.5% on an annualized basis, but that's really slowed. Last year, they had $3.6 billion in revenue. That's projected to be $3.7 this year. And in that time, margins have started to contract as well. From a high in 2020 of 17.2 was 16.5 last year in terms of net margin. Their cash flow is steadily falling a little bit as well. They have been buying back shares. They did have a massive share buyback program that they instituted maybe 6 months ago, and they have bought back some, and we expect them to buy back more into the future. But I think the reason why there's almost 10% short interest out there is that most of their revenue, 73% of the revenue, comes from the assisted or do-it-yourself tax preparation services. Now, I don't yet know how the life of this government initiative, what it will look like in a new administration, though I don't believe the future Trump administration has said anything about taking down the program for a free tax filing service. I just think this has some asymmetric risks outside of the market. That's why, from a momentum perspective, it does not look that great. That's why it's down 12.2% in the past 3 months. And honestly, sitting at a 10 times forward-looking earnings, 10 times cash flow, it does seem cheap, but I just think that in this situation, I would keep this on my watch list for now. I would wait if I was looking to buy this, just to get some clarity on the future of that initiative. Thanks for the call. I hope you've been telling all your friends and family members that Our InvestTalk podcast, our radio show, you can also stream it on our website if you would like to, is not just available in audio form, but it's also available in video form over there on our InvestTalk YouTube channel. We've been having that going for a while, and we've been hearing from clients, we've been hearing from listeners that they like going over there and watching and seeing the charts that we show and seeing the stories that we're going through and for some reason looking at us while we do this. And when you're over there, if you have a question, well, it is also very easy to just leave it in the comment section of our YouTube channel. We get to those as quickly as we can. And let's get to one now from our friend JDude88, great name. And it's about VAW. It says, I was looking at the materials sector and unsure why there was a drop at the end of December. What are your thoughts on this? And would you consider adding to a materials ETF like VAW at this time? So let's take a look at VAW. So VAW is the Vanguard Materials ETF. What it does is it gives you broad exposure to just US basic materials using a market cap weighted approach. And it stretches across all of these sub-industries and has the MSCI IMI Materials Index as the benchmark, which tells me that this should be a all cap fund, right? From large all the way down to micro caps, because the IMI stands for the investable market index, for those of you who don't know. And I would be right, 78% in large caps, 18% in mid caps, looks like 2.688% in small caps, 0.36% in micro caps. If you're watching this on YouTube, you can clearly see the breakdown here pretty much matches the benchmark. Most of the revenue coming from the United States, but these are companies that operate globally, though they are all based within the United States. And so, first off, what is going on with the materials sector? Well, there's been a little bit of a global economic slowdown, right? There's reduced demand, particularly from China. There's higher interest rates on the longer end of the curve. A stronger dollar, making U.S. exports more expensive, could hurt the materials sector as well. And then tariffs potentially on the horizon, which could hurt the industry broadly, which could be why, over the past 1 month, materials are down 9.11%. They're pretty flat over the past quarter, year to date, which is just a couple of days, only down 55 basis points. Now, that's a cheap fund, right? 10 basis point expense ratio, which is exactly what I would expect because, well, it's just a passively managed fund. It's just tracking this index. It has 119 names. At a market cap weight, it's got a lot of exposure to that top name, but that's because it's a large name. And so if you are trying to get a passive exposure to the material sector, this is exactly how you would want to do it, right? Vanguard funds are well managed, they are cheap, and they get you that broad exposure. How do I know they're getting that broad exposure? Look at this market cap breakdown again. It is perfectly nailed to where the MSCI IMI is going to be. So this is a passively managed fund. You're not getting any of the additional benefits of active trading, right? You are not able to benefit from the fund selling, losers rebalancing, taking tax advantage, anything like that. This is just a passively managed fund. So if you were trying to get that broad exposure, I think VAW is a good way to do it. But I would caution you because, as I've said, we're going to get some clarity on tariffs. We're going to get some clarity on policy that will affect the materials sector specifically in just a couple weeks now. So VAW, I think, solid fund if you're looking for materials exposure in the United States. Looks like we got plenty of time, so let's play another question right before we head to a break.
My question is on the stock UHT, Universal Health Realty Income. I was just wondering what your thought would be. And again, this is Steve from Virginia. Thank you.
Well, Steve from Virginia, UHT, Universal Health Realty Income Trust is a real estate investment trust, which means that it invests and leases in primarily healthcare and human service facilities through direct ownership of joint ventures. It is down 14%, 15% almost over the past 52 weeks. A lot of that comes from the past 3 months because it's down 14% over the past 3 months. Now, when we come back from the break, we will dive into maybe some of the properties that they own, the trends within the real estate industry, what we expect to drive not just healthcare REITs, but REITs broadly, and answer the question, is UHT a good name to buy?
To enhance your financial knowledge, check out our website at investtalk.com.
Now, before we headed into the break, we were answering a question on UHT, which is Universal Health Realty Income Trust. And it's had a rough past 3 months. Now, this is a $500 million market cap REIT, and it's got quite a bit of debt, about $378 million. But, that's mostly how REIT businesses operate. And so why over the past 3 months has this REIT been, underperforming the industry and underperforming the market broadly? And the answer is threefold, right? You have rising interest rates, especially on the longer end of the curve. You have earnings that have been declining over the past several quarters, from 1.53 earnings per share back in 2022 down to 1.11. 2.29 is where it was this most recent quarter. Now it's just for the singular quarter. So, but you can still see the trend is downward. The cash flow trend is downward. The funds from operation growth has slowed. Funds from operation per share has only been growing at 40 basis points on an annualized basis over the past 4 years. But they've been growing their dividend. That's certainly something that is true. But if you cannot continue to grow the business, if you cannot continue to grow the cash flow, the dividend growth becomes unsustainable. Their payout ratio is 258 right now. That is not a sustainable dividend, which is why when you look at that juicy 8.2% dividend yield, you have to get up, go to the bathroom, look in the mirror, and tell yourself this does not make sense. And so because of that, I would say UHT, thumbs down. Thanks for the call.
Hi, this is Sid from Charlotte, North Carolina. First of all, Happy New Year to all of you, and thanks for your time and everything that you are doing. I have a question regarding ticker symbol MSM, Mary, Sam, Mary. I own a small position, and I would like to know, is this a good name to pursue for a long term? I'm having right now 5 to 10% of loss, but I can take that one considering the other profit I have. So please let me know what you think. I'll listen your response on the podcast. Thank you once again. Happy New Year.
Well, Happy New Year to you as well. Let's dive right into this question on ticker MSM. That is MSC Industrial Direct Company. It is out of New York in the United States of America. It's a $4.4 billion market cap company. It's got a little bit of debt, about $500 million in debt, so not too much. Earnings have been headed in the wrong direction, though. That's the first thing that I see. Net income down at 2.2% on an annualized basis over the past 5 years. Hit a high, though, in 2023, but it's fallen off a cliff, projected to be $206 million, down from $340 million just 3 years ago. And in that time, margins have collapsed as well, from a high of 9.2% net margin all the way down to 5.5%. Now, one other thing that is interesting to note here is that the company declared a higher dividend, even with income falling. That's why their dividend yield right now sits at 4.26%. You see their dividend per share growth, even with net income falling, growing pretty consistently over the past 5 years, but it's starting to stretch the ability of the company to pay this dividend. Their payout ratio sitting at 72, nothing too crazy, but still a little higher than we like to see for that consistent long-term dividend. Now, with profitability headed in the wrong direction, cash flows headed in the wrong direction as well. It's got quite a bit of short interest out there at about 8.18%. And so looking at this, I would expect that maybe it's trading at or near or even below its 5-year average range in terms of forward-looking earnings, in terms of price to book value. But I'd be wrong. It's trading at 21 times forward-looking earnings. It's trading at only 1.2 at sales, but still it looks a little expensive for me for the lack of growth. Even if you ignore the bottom line, the top line has not been growing well either, all the way back into 2023. It fell from $4 billion in revenue to 3.8 last year. It's supposed to fall again to 3.7 this upcoming year. So I wouldn't quite classify this as a sell yet. I'm still a hold and wait and see. We got earnings coming out again in, actually today or tomorrow. Not sure how it's trading after hours or what came of that. Haven't had a chance to look into that yet. Actually, I'm sorry. The earnings came out a couple weeks ago, so it actually did beat consensus. And so that's why I meant a couple days ago. And so that's why it's up, well, about 10% year to date, even though in the past year it's down about 13%. So honestly, at this bump, you're probably up a little bit, depending on when you left that voicemail for us. Maybe I would consider trimming a little bit of it. Still, I think in a hold range, but some exuberance post earnings that you could take advantage of to just rebalance your portfolio into something that honestly has better growth prospects. That is MSC Industrial Direct, MSM. Story that I want to talk about today, which is an important one for moving markets. It always is. And that is the recent comments from the Federal Reserve. Now, the Federal Reserve's latest meeting minutes reveal a cautious yet divided approach to interest rate decisions. In December, Fed officials lowered rates by a quarter point, bringing the benchmark rate to a range of 4.25% to 4.5%. But the decision was described as finely balanced, with some officials advocating for even holding rates steady back in December, let alone holding rates steady now moving into the future. Now, one key concern that was highlighted in the minutes is probably the most important aspect for the Fed, which is the potential inflationary impact of President-elect Donald Trump's proposed tariffs, but also his promised mass deportation and immigration policies. Remember, recently, in the recent past, the Fed has talked about how one of the reasons why U.S. economic growth has been so outsized compared to the rest of the world was because of the inflow of cheap labor, even with the inflationary pressures. Now, while inflation is expected to decline towards the Fed's 2% target, officials acknowledged it might take longer than they previously thought, right? With upside risk to inflation now potently on their radar. Now, this uncertainty has also prompted the Fed to scale back its expectations for future rate cuts. In December, officials signaled just 2 cuts this year, down from 4, which is what they expected in September. Still, some officials like Fed Governor Christopher Waller believe further reductions will be necessary to ensure continued progress in lowering inflation. But markets are now watching pretty closely. Investors anticipate the Fed will pause rate cuts until at least May, maybe even June, maybe even later in the year. Meanwhile, Richmond Fed President Tom Barkin warns that tariffs and potential wage pressures could really embolden businesses to raise prices, which would complicate the inflation outlook beyond what they can even see right now. And so as the Trump administration takes office in just under 2 weeks now, the Fed faces a delicate balancing act, right? Sustaining economic growth, but also maintaining its progress on inflation over the past several years. And so with that uncertainty looming, and really with clarity coming, all eyes are on how these dynamics will unfold in the days, weeks, and months ahead. Let's keep things moving. Pivot back to the InvestTalk voice bank. You know the number, 888-99-CHART.
This is Kyle from Chicago. I worked at Kellogg for 3 years, and I participated at the time in their stock program. Basically, I was able to buy stock at a 15% discount. Kellogg split, became 2 companies, so one was snacking and the other was cereal. So I have about 40 or 50 shares of Kellogg, and then I have 150 shares of Kellanova. Kellanova was basically Mars, the candy company, announced that they were going to acquire Kellanova. It went up about 50%. The acquisition is supposed to happen sometime in 2025, and my question really is, should I wait for that acquisition to happen, or should I sell when it's up 50%? And then the other question, I'm up about 34, 35% on Kellogg, and I'm curious if I should hold on to Kellogg or if you would recommend selling that stock as well. Again, both were bought under that employee purchase program. Really like the show. Thank you so much, and I'll be listening.
So that's a great question because there's a broader point here. To answer your question specifically, if you're up 50% and you're waiting on a merger that is expected, it's probably already priced in to the price. And so essentially you're either going to see the negative return from the merger falling through, or you're just going to be trading like cash until the merger goes through eventually. So from the 50% up, I would absolutely get rid of that. Move into something else. Now, on the other shareholdings, this is something we talk about with clients all the time. Now, you mentioned that you were part of an employee stock purchase program, and maybe I heard it incorrectly, but I don't believe I heard you say that you no longer work there, which means that you have assets on the equity side that are tied to the same risk factors of your income. Now, Kellogg is a large company. It may not go bankrupt tomorrow, but the broader point here is diversifying risk. You don't want a large portion of your equity assets or a large portion of your assets in general to be exposed to the same risks as the things that drive your income. Because let's take the example that Kellogg goes under. It no longer exists tomorrow. Well, now not only are your assets worthless, but also you don't have any more income. So we generally tell our clients, and we generally tell anybody that we do portfolio reviews with, that if you have that exposure with the stock options through employee purchase plans, through restricted stock options, or what have you, as those vest, as those come through, it's a good idea to take advantage of divesting from those things, to diversify your portfolio away from what your primary source of income is. Just a great lesson broadly for anybody who gets stock options, who gets stock from the companies they work for. Always a good idea. Diversification. They say it's the only free lunch in investing. Thanks for the call. Let's try to answer another question. It didn't go so well last time because sometime I just can't look up companies, or rather funds is the issue. Companies usually do always come up, but funds tend to be the problem. So let's look at a company right now. This one, Nordson Corp. There's ticker NDSN from our friend Rackdon 1964. And the question is, Nordson Corp, NDSN, that is, seems to have been in a negative trend, but I remember you guys liked it a while back. Is it cheap enough to buy now? I have a little, and being a dividend king, would like to pick up more. As always, you present valuable information. Well, thanks, Dan. Hope you're having a wonderful New Year's. Now, ticker NDSN, I've said the name several times, but I'll say it again. That is Nordson Corp, is an engineering, manufacturing, and products company for adhesives, coatings, sealants, biomaterials, and other materials as well. Their industrial precision segment is what makes up a majority of their business at 55%. And they have a medical sales business as well, makes up about 26%. Over the past year, it's down about 20%. The reason why is probably due to some slowing revenue growth here. You see over the past 5 years, they'd grow at a 4.2% annualized basis, but that's really slowed since about 2023, when they've only grown from 2.6 billion, projected to be 2.8 billion this year. Whereas the other part of the period, they grew from 2.19 all the way up to 2.62. Now, in that time, margins have started to taper down, though they're projected to improve this year from a high of 19.8% net margin to about 7.4% last year. Now, they did recently do a strategic acquisition, which probably has helped growth a little bit. You see that stagnation in 2023 and 2024. That could be why revenue growth is projected to grow again at a better rate heading into next year. But there's still some operational challenges, right? They've had increased issues selling in general. Margins have been compressing because of administrative expenses, which have risen by almost 13% in the fourth quarter of last year compared to the previous year. And these factors are really driving Nordson down really more than we would like to see. Now, from a technical perspective, it doesn't look great. It's broken down. And from a relative valuation perspective, I mean, we see that it's well below its 5-year average, right? Its forward-looking price to earnings trading about 20 times below the 5-year average of about 25 times. But I'm not seeing anything from a momentum perspective, especially given that earnings are on the horizon. And really, we're in this middle period where it's trading in a choppy fashion like a lot of the market. I don't see anything that is telling me that now is a good time to buy this company. I don't like where margins are heading. I don't like where growth is slowing. So for now, I would keep it on the side. I would not get into Nordson. That is ticker NDSN. Thanks for the call. Now we got time, so let's drop in another listener question now.
You should never have one stock be more than 5% of your portfolio. When you say 5% of your portfolio, do you mean of just your stock portfolio, or does that count like your cash and retirement account as well? Is it just your stock portfolio, that everything together, that it shouldn't be more than 5% of? Thank you. I'll listen on the podcast.
That is a great question. So when we talk about 5% of your portfolio, some people go really inclusive, and they're talking about their house, right? They're talking about all of their non-liquid assets as well. Generally, I give the advice of liquid assets. I'm talking about your stocks, your bonds, your investment portfolio, not just this is my IRA, this is my 401k, this is my Roth, this is my brokerage account. I mean, you should look at it in a holistic way where you're looking at all your investable assets, probably excluding your house, which is the primary savings vehicle for a lot of people. So I would exclude that. But generally, you want to look at your whole picture when you're deciding that 5%. I think it makes it a little bit easier, but it also helps you better understand what we're talking about when we think of having too much concentration risk in your portfolio. Easy one to answer, but an important lesson to know. Thanks for the call. Thank you for watching.
If you liked what you saw, make sure to give us a like and subscribe for more informative content.
Let's go to Bill from Northern California. His question about ENB and listening on AM 1220 in the Bay Area. Do you own it or are you looking to buy it?
Yeah, hey, Luke. Yeah, I do own some. I wasn't going to call today when you said there was no callers.
I was getting lonely, Bill.
Am I the first one ever? I got my exclusive day today, so I'll be.
You got your whole day. There's going to be nobody for 23 hours. That's great. Thanks for calling, Bill. So let's take a look at Enbridge.
I bought this, last year. I think even some the year before, and it's gone up with the gas prices. And I just wondered how you would look at this going into the, they say the gas shortages and also over, in Europe and stuff. Is that going to cause us to go up? You think?
Well, let's take a look. For those of you who don't know, Enbridge is a gas and oil company, and a lot of its revenue comes from gas, right? It's a Canadian company. It's one that we really like. We get questions about it all the time. We did own it at one point. We no longer own it. We have invested in some really US-based oil and gas companies instead. But regardless, they're doing pretty well, right? They're up 3.75% year to date. That's just in the past couple weeks. They're up 27% over the past 52 weeks, as a lot of the energy sector has begun to sag with the depression in oil prices. Now, we've been saying for quite some time, I've been saying at least for quite some time, that the thing that I like heading forward into the Trump 2.0 for the energy sector is not necessarily oil companies, because they've been drilling a lot, but I like gas companies because there has to be a replacement demand for Russian gas in Europe, and also pipeline companies. And they operate extensive pipeline networks, which has really bolstered this price action over the past 3 months, up 14% over the past 3 months. So the question is, to me, not is it a good company, but is it a good company at a good price? And I expect that with these dynamics, with these trends, that companies like Enbridge will do pretty well over the short to medium to long term because of what is going on. And honestly, it's not trading at too high of a multiple for me. It's trading at 20 times forward-looking earnings, which is near its high range, but not at its high range. It's not too much over where its 5-year average is. Its price to book is only 2.3. So I like Enbridge. I like companies like Enbridge. I think if you're going to invest in the energy sector, the pipeline operators, the ones that are focusing a lot on gas, I think are going to do very well in the foreseeable future. And you know what, Bill?
That's great. Thank you.
I appreciate you calling.
Thank you.
You made my day. Now, before we got Bill's wonderful call, we were talking about how the market has been digesting what it perceives to be changes really in a couple weeks, and how the dollar has surged in value, driven by expectations of higher tariffs, but also America's growing appeal as a safe haven currency. The peso and Canadian dollar, tied to key export markets, have really taken a hit, which also reflects the serious concern about potential trade barriers. Meanwhile, U.S. stock markets have been on a tear, with American companies outpacing their global peers. Analysts credit this to investor confidence in domestic policies that may bolster consumer spending, and also, more importantly, probably reduce regulations, reduce taxes. But not every sector is benefiting. Oil and gas companies haven't really been buoyed as much by Trump's drill baby drill rhetoric, as low oil prices remain a constraint. We just talked about why we like gas and pipelines, but oil has really weighed down on the energy sector broadly. Real estate firms are also feeling the pinch from rising borrowing costs, while materials companies are grappling with something we saw earlier when we looked at a materials company we got a question on, which is the potential tariffs on imported goods. Now, in the bond market, Treasury yields have climbed sharply, with the 10-year yield now at 4.6%, up from 3.6% just 30 days ago. And investors are increasingly worried about inflation risks tied to Trump's policies. Now, these factors could, as it already has, as we've seen through the Fed minutes, compel the Fed to maintain these elevated interest rate levels, at least elevated by recent standards. The rising term premium, which is an indicator of investor concerns about bond price crashes, accounts for much of the recent yield increase, though, it's important to note. Now, while experts don't expect yields to soar dramatically, the bond market's turbulence could spill over into equities, a metric of success that Trump has really been known to watch closely. So as Trump's policies come into focus in the coming weeks and months, market participants may shift strategies, potentially altering the market for this next 6 months. I'm Luke Guerrero. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. Please be sure to review and rate us on iTunes. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number. We can also help you optimize the potential of your 401k. It all starts over at InvestTalk.com. Just click on the portfolio review button. It's a free and confidential service. Independent thinking, shared success. This is InvestTalk. Good night.